Does take us to our talk of the tape, stock strategies. What's your best one right now? Let's ask Cameron Dawson, Chief Investment Officer at NewEdge Wealth, here with me as you see it, Post 9. Welcome back.
Good to see you.
What do you make of the price action, first and foremost? Post-NVIDIA earnings, what that stock's doing, and then what the rest of the market was doing and is now doing as we begin our conversation.
Yeah, the whipsaw is something that we've been expecting to continue to see simply because we still are in August. It still is light trading, and this is a time that we typically see higher volatility. Clearly, we are hitting some pretty formidable resistance when it comes to the S&P 500 at the July high, and getting over that is a really important step for this market. So until we do, we just expect to see more chop and churn.
5,600 is sort of that number you're talking about. 5,667 or so is where you have to get a new high. Tech's been teetering a little bit, hasn't it? And do you feel like that's kind of where we are? We're still yet to resolve the future of that trade, at least the immediate future?
Tech has certainly been losing steam, and if we look at the bounce off of the August lows, it hasn't been nearly as robust as the rest of the market. It still is well below its July high, which means that it's making a lower high. We've seen it trade now below its 50-day moving average, I think, today. You also see some of that relative performance starting to deteriorate, which just suggests that some of the ultra dominance that we have seen in tech really over the last 18 months is starting to show signs of fading, or at least a little bit of losing energy, and meaning that the rest of the market has to take it up in order for this market to continue to move higher.
It kind of has been doing that. So isn't this good, right? If people argue, well, the market needs to broaden. It's not broad enough. It's back towards mega cap tech, and that's really the only thing that's really, really working and that you can believe in. Then you get broadening, and tech sort of takes a bit of a backseat, and they don't like that either.
What we'd say is that tech has to at least participate on average with the market. It can't be down and it can't be lagging significantly because, after all, it is 30% of the S&P 500. So that would be a big drag on overall performance. We think that the reason you've seen this broadening is because this expectation that the Mag 7 is going to see lower earnings growth in 2025 than it did in 24, whereas the market now expects the rest of the market, the 493, to see a big acceleration next year. The question is, can the 493 deliver? And we think that that remains a very much open question.
Well, because you need to see what earnings do.
Exactly.
That's going to be the tell. Are you confident or not?
We think 2025 estimates are too high. It doesn't necessarily mean that the market can completely lose steam and mean that we've hit a high in the market. We think that we will eventually start to see those estimates move lower as we get closer to 2025. And we think the fact that there is such a high bar for this 493 is something that makes it harder to jump over. Remember, at the beginning of 2024, the market expected a broadening as well, but it didn't get it because earnings disappointed in things like energy and materials and tech and healthcare and industrials on down the list. Tech was the only place that was surprising to the upside, hence tech's leadership.
Are you bothered by what some would characterize to be a more defensive nature of the recent price action in the market? Utilities and some of the other more defensive, traditionally areas of the market had been leading. Is that a bad thing?
Classic intermarket analysis would say yes. If utilities and staples and healthcare are leading, it's a sign of risk aversion and people having more growth fears. So if you see that performance continue, it is a sign that there is an underlying growth fear in this market that we shouldn't ignore. Also pay attention to things like IPOs and high beta stocks underperforming. That's the opposite side of that trade, and that has been showing weakness, which suggests that there is some brewing growth fear.